Hey, what is up guys, welcome back to ProTraderPath. I'm back with another video, and in today's video, as promised, I'm going to talk about the ICT Dealing Range type 2 or part 2. Like in my previous video, I talked about how the consolidation or engineered liquidity during a accumulation phase works. So market does mostly like this, creating a equal or relative equal high or a range bound price action that it's creating consistently high and low around the same range or same area. Once the buy side is taken, we wait for the sell side to be taken. You want to see the pullback first because you don't know where the low is. So a pullback to the range, that's your dealing range confirmed. Now around this area on the lower time frame, you want to look for something like this liquidity grab market structure shift, and this high is important. If you have watched my previous video, you know why this high is very important. However, your target should be this sell side liquidity or anything relative to this liquidity. You can target that, or if you have a set risk to reward ratio that you prefer, you can target that as well. So in short, that's the previous video. If you have missed it, I highly recommend and suggest you to go to my channel and look for the video that says ICT Dealing Range type 1 in my channel. You will find this one where I have talked about it in depth. It's a long video over there, nearly 1 hour. And in today's video, since a lot of the concept and topic are from the previous video, so I will be making it as short as possible. So in today's video, I'm going to talk about the engineered liquidity or the dealing range during a trending market. What do I mean by that? Sometimes you will see, instead of accumulating like this, okay, like creating a range bound price action or accumulation phase is in a range bound area, you will see price is doing something like this. It's creating consistently a higher high, a higher low, higher high, higher low, higher high, higher low, something like that, and finally it breaks lower, takes the sell side, and then market goes and creates your dealing range. However, if I want to explain this a better way, what it looks like is, on your higher time frame, it can be any time frame, then what time frame you are trading into. Let's say in today's example that I have selected to show you guys, it's in a hourly time frame, and from the hourly I will drop down to maybe 15 minutes or something lower to show the execution levels as well, how you can utilize it. So how it gonna work is, price will create consistently like liquidity to imbalance, then taking the previous liquidity imbalance or some PDRs, or in short you can say the retracement, again taking the buy side. Opposite is true for the sell side as well, like the trending sell side and market structure shift to the opposite side, things like that. I'm gonna come slowly. So it creating consistently higher highs and higher lows at a certain level. It's already like every time it's going above your buy side liquidity, it's taking that buy side liquidity, right? On the other hand, you will see it's generating sell side liquidities. So when market takes your buy side liquidity, and there can be maybe some other old highs around this area that market took or price took along with that high, and then market is going towards the downside until it takes your sell side liquidity, in this case this one. So until it takes your sell side liquidity, you will do nothing but wait. So if there is no previous old buy side liquidity, you can look into the recent swing high that price has taken, that you can mark that as your buy side liquidity. But until market takes the sell side liquidity and gives you a retracement to the zone, you have no dealing range, okay, because you don't know how low it can go. Okay, there is nothing that can give you the confirmation that okay, this is the lowest market can reach. So until you see a retracement to the range and into the premium and discount, the way I actually showed you on my previous video, I hope you watched that, you captured some of the information, and now you're watching this one. If you are watching this for the first time, or you haven't watched my previous video, please go through that video first so that you can make sure that what I'm saying here is making sense to you. So yeah, like OTZ or whatever, there will be your maybe fair value gap, inversion fair value gap, breaker block, PDRs, right? So if you don't know the PDRs, I will make another video about that as well. So let me know in the comment that you want to know the PDRs or premium discount arrays. Buy side liquidity taken, sell side liquidity taken, from that high to the low it reached and then retraced. If it doesn't reach to your premium area for a sell short setup, you wait until it actually goes there. Especially you mark it with your OTZ from the high to low. If the OTZ is falling with the current swing high that it created, or the short term swing high, or pullback, or trade into the range, however you want to do it, it's called rebalance or balance to the range. Okay, so this is the balancing or rebalancing, however you want to call it. You want to see that, and on higher time frame it will look like this, a single swing high. But if you drop down to a lower time frame where you usually trade, you will find your sell side setup, which is the typical ICT, like liquidity grab, market structure shift, then fair value gap, retest to that, and then market is delivering to the side that you have anticipated. So what gonna happen here is, market, once it takes the buy side and the sell side, and then it goes to your premium and discount area or OTZ, however you want to mark it. I hope in real chart it gonna make more sense when I'm gonna show the real chart. So yeah, once this retracement is done into a fair value or whatever premium discount arrays that you have mastered during your journey, I highly suggest you to focus on the fair value gap at the very beginning, or inversion fair value. Like the fair value gaps are the most important part that you can actually learn and get consistent result with. Also the breaker blocks, order blocks, if you have back tested it, what sort of order block or at what certain time the breaker block or order block works, you can utilize that in your trading strategy as well. Anyway, so yeah, so once that retracement is done, you will find your lower time frame setup inside of that, and the setup will look something like this. So remember, the left side is higher time frame and the right side that I'm showing here is lower time frame. So in lower time frame it will look something like this. Price will again retest or rebalance to a PDRA of this small range on your small time lower time frame, and then it will deliver toward the sell side. And the exception that I talked about, if you remember, like instead of coming and taking this liquidity, if market goes higher and takes that swing high, let's say market created this, it came up to maybe this far, it didn't take the liquidity, it went higher and took that liquidity, the highest it reached during the higher time frame pullback. Okay, if it takes this liquidity, you know what to target, right? You switch your bias from the sell side to the buy side liquidity, that dealing range high. Okay, so in this term, once it takes this, you will find something like this happening. So liquidity market structure, when market pulls back to your premium and discount area of this leg, or in this case you can simply use the fair value gap or breaker block, order block, whatever you have mastered, as I'm saying over and over again, and then you can target this buy side liquidity. So once that happens, maybe later on you will find your other setup for the new premium and discount, new dealing range or something. But that's how the market works in terms of the other type of dealing range, which is in a trending market. You will see market consistently respecting some bullish PDRA and going higher, creating higher, leaving almost all the sell side liquidities. Like why I said almost, sometimes it may come and take one or two of the internal liquidities, but it eventually it's leaving more liquidities on the sell side and it's grabbing all the liquidities from the buy side. So however you find your zone, that's why I said like you have to back test and forward test it by yourself so that you know these things. Why I'm showing this to you guys is because, you know, like we have 3 silver bullet sessions, we have so many macros, like around 6 or 7 macros in a day. If you are not finding a setup during that time, there will be these formats or these setups in other times. How can you utilize your other time regarding, let's say you missed your silver bullet but you are seeing a trend like this, or my previous video, the dealing range type 1 or part 1, type that sort of trend. You can look for your setup if it's clear. Okay, this is something I'm saying over and over again, you must have to learn and observe by yourself. If you don't do that, you will lose your money, you will lose your trade. Okay, and also if you don't observe it properly or backtest it properly, if market does the opposite thing, the thing that I just mentioned, that without taking the sell side, it went up and took the recent swing high or the rebalance high that price created on your higher time frame or even on your lower time frame, and you will find your setup here for the buy side and you will miss it because you don't have, because you already lost a trade, right? Like what you expected, it didn't deliver that. Instead it took the buy side liquidity and it stopped you out. So what you will do is, when it's time for you to actually switch the bias and look for the buy side liquidity or delivery, you will not take your entry over there and you will eventually end your day as a losing day. Instead, what you could do with the same risk to reward or with the same risk amount, you could easily mitigate your losing trade and make it a profitable day if you utilize that one. So yeah, it's very important, really important to know these things by yourself and practice these things on your own, so that when it's time you can execute without fearing another loss or any other thing. Okay, so let's jump into the real chart and let me give you a good example of how these things works. Okay, so here I'm on the hourly chart of British pound and Australian dollar or Aussie dollar. As you can see, price is consistently creating higher highs and higher lows. Yes, as I said, it can take some liquidity on its way up, but what happened actually? Price creating high, creating low, high, just high, or I can say like another swing low. It's consistently creating that move. Okay, and at this far, what I can see, it's just taking the buy side liquidity, but it's leaving all these, like I'm gonna mark too many lines over here so that you can identify how many sell side liquidities it's actually leaving behind. Okay, all this. On the other hand, it has reached until this far, and if I'm not wrong, it will take this liquidity as well along with the recent swing high. So all these liquidities are sell side liquidity. Okay, I'm gonna remove that trend line that I have drawn. Now this is all sell side, and on your chart you only have two buy side liquidities, 1 and 2, at whatever I can see around this area. Okay, that's the highest I can see on my chart. So that's the buy side, and this is the buy side that price just left or created. Okay, and let's see what happens next. Now price took both of those buy sides. It's now in a phase of creating a sell side, so I'm gonna just keep this on as my buy side liquidity, since that's the highest buy side that I can see and the recent buy side that price just created. Okay, and look how many sell side I have. Oh sorry, that's the buy side. Okay, however, look how many sell side it has created. So I'm gonna keep the lowest as my sell side, and in between whatever the lines are, I will remove all of them, or I will simply remove all and go keep this on and this on. Okay, I don't know if this is my dealing range or not until it takes the sell side. Since I can see it took this buy side and this buy side, I'm just gonna mark the recent swing high as my buy side liquidity, since it's already taken all other highs and the recent swing low that price created during this trending dealing range formation. Okay, or engineered liquidity on the sell side. So let's see, I have now buy side taken here, also buy side taken here. Okay, I hope you got that point. So I have liquidity taken from recent swing highs and the immediate, like previous swing high and recent swing high. Now if market comes lower and takes this liquidity, that will be my buy side manipulation done, and sell side distribution. Okay, so let's wait until market actually comes lower and takes the sell side. Okay, now market has taken the sell side liquidity. Also there is another thing, this swing low took this low as well, okay, as my sell side. So now I'm just keeping this line, but since this is a swing low it created, my dealing range will be from that buy side to this sell side or this swing low. Okay, but I'm just keeping an eye on the recent swing low and from where it is retracing. As you can see, there is a hourly breakaway gap over there. Why breakaway gap? Let's talk about that a little before I go to the other part. The hourly fair value gap, after liquidity taken market structure shift, price came retested by that much, only a single tick. Okay, it left all the area open or unfilled. So when price keeps the area unfilled, that's your breakaway gap. And look where price came, right around that area. And if I just keep the unfilled area like this, you will find it's still tapping there. Okay, it's still tapping that area. Now price is going higher. I don't know if this is my dealing range or not until I see price is actually reaching for what, my premium area. Especially if I draw my OTZ, it will be even better. So inside of my OTZ, what I have a fair value gap, that is hourly fair value. And what else do I have around this area? Okay, I have a breaker block sitting here. Why this is a breaker block? High, low, higher, high, market structure shift, liquidity grab, market structure shift, the lowest down close candle with the lowest body, that's my breaker block. So that's my hourly breaker block. Okay, so 1 hour, and in this case this is a bearish breaker block. So bearish fair value, those are the areas I'm gonna look into, like where price can reach and retrace. Okay, remember that's in my OTZ and in the premium area. So let's see what price does when. Okay, so here let me go one more candle. Okay, so as you can see here, price didn't respect this one at all. It went straight through that to that breaker block, hourly breaker block. Now I can see some sort of liquidity grab on hourly here. So let me drop down to 15 minutes. That's my dealing range sell side, that's my dealing range buy side. Price came to the OTZ, the hourly breaker block, which I can in 15 minutes readjust, but it's okay, I'm not gonna touch it since that's my higher time frame point of interest or PDRA. And this is a possible liquidity if I see market is displacing lower than this. So let's see what happened. Let me just reduce the speed so that it doesn't give me too many of the candles. So price didn't break below that low. Instead price took the liquidity from recent swing high, or even that's not a swing high, but anyway, because it's equal. Okay, equal highs, but it's liquidity grab. I'm gonna mark that liquidity grab. Now I can consider this as my market structure shift since it created a clear swing low over there. Let's see if I can get a displacement below that or not. So remember, that's coming out from my hourly fair value or point of interest. Okay, so market disrespecting the bullish fair values and going lower. Okay, so this is a bullish order block, market disrespecting that, or even this one, whatever you count, since it's coming out from a fair value gap, I would consider this. Even this is coming out from a fair value. So yeah, I mean both of them are bullish fair values, and market just disrespected that straight away and it gave me my market structure shift. So if I can get a entry at around this level, I would love to take that entry. Okay, but let's see, like this is my point of interest where I'm willing to take the entry since it displaced below that recent swing low. Even it came to this low as well, and at the same time it created this huge fair value gap. Okay, and the stop loss, this is, in my opinion, this can be a safe stop loss. However, if you are too conservative, remember what high is very important, this swing high is very important. So I'm gonna mark this one in a different color and I'm gonna write POI. Okay, I'm just gonna write POI. The reason point of interest is because if market comes lower, fails to take the sell side liquidity and goes above that swing high, I'm gonna shift my bias and look for the buy side delivery after that is taken. But for now, let's go where I can go. Okay, so this is just a possible entry. I don't know what happened after that specific fair value, if I got the entry or not. So yeah, two things you can do. It's a huge, see, like when you get something like this on a higher time frame, it's a very good thing. Okay, although it's gonna take couple of days to form, but that's how beautiful it looks like. You can do two things. Number one is you can just simply put your stop loss at this like swing high where price is currently coming from, or if you want to be very safe, you can put this as your stop loss, like the swing high. That is most important. Why it's important, you know, right? If price takes that liquidity, since I have already got my market structure shift on the lower time frame, I don't want price to take that liquidity. If price takes that liquidity, let's say it came a bit lower around this area and went higher and took that liquidity, if that is taken, I'm gonna shift my bias towards the buy side delivery. I hope you got my point from the first video as well. So yeah, if you want to be safe, you can put there, but remember how we take the order. Whatever you risk, regardless of your stop loss size or positioning, you risk the exact same amount. You don't risk anything extra or anything less. If this is your stop loss, you risk the same. Let's say for 1% risk on a 50,000 account, that will be $500. So from here to here, if price reach, you are willing to pay $500. Okay, the same way, if this is your stop loss, you don't risk 1.5% or 2%. okay, you don't increase your risk, you just increase your stop loss size, but the risk will always remain the same. What gonna happen is, let's say you could take 5 lots of this as your risk when your stop loss was here. If you increase that with the same amount or same percentage risk, you can now take 3 lots. You are taking less positions but same risk. Okay, and also your risk to reward will be reduced as well. But okay, I hope that's good enough talking regarding your position placement. So price, okay, price tapped here, price came lower. Remember, what is it respecting around this area? The higher time frame breaker block. Look around this area, what it is respecting. This is your breaker block. Why? Because that's a clean swing high, swing low, and this is the high. So high, low, higher, high, price took the liquidity, and that's the lowest down close candle. Price tapped into that. Also, if you have wrongly selected this one in this term, that's your breaker block tap and market coming lower. However, I don't suggest this one as a breaker block. This is the proper breaker block in this term. So clean swing high, swing low, and swing high. Not this. This is equal highs. Although it took the liquidity, if market gave me the market structure shift from here, this would have been my breaker block. Since it's equal high, market took that liquidity once again and then it came lower. And instead of looking at into this as your market structure shift, this is what I call internal market structure shift. Remember, this is a proper market structure shift. Okay, like high, low, higher, high, that's a proper market structure shift. Anyway, you somehow, since I didn't get my entry over here, you somehow missed that entry. Okay, I'm gonna keep everything the same. I'm gonna look into what happens next. Okay, so now market created another fair value gap. In this case, if I'm entering from this fair value, all I want to do is I want to put my stop loss here or maybe at this high. I'm not gonna put that high anymore. Why? Is because I'm already taking my entry from a lower part, and now market has created two fair values. Okay, so this is one fair value, there is another fair value. So if I take my entry from this fair value, I'm gonna cover this fair value, since it should act as a breakaway gap. Remember the breakaway gap, at least this will be the breakaway gap. Okay, so let me just put the mark of the fair value so that you understand what I'm talking about. When there are two fair value gaps, that's what I typically do or usually do. So let's see what happened next. Market came lower. Okay, now I'm in a trade. Now let me see what's the risk to reward is giving me at that swing low. It's 5.14. What I told about 5.14 or higher targets is at least close some partial at 1 to 2. Okay, I don't know, it's up to you. I don't know if that's a 1 to 2 or not. I just randomly draw that. So close some partial, take some partial, or if you have like clean liquidities like this, you can target that as well. I don't know, like it's up to you how you anticipate the market. Let's see what happened after. Okay, so market creating more structures like break of structure, 1 fair value, 2 fair value, that one is tapped. Market coming higher, tapped the fair value one more time, so you got on another chance over there if you wanted to take. Let me actually speed it up. 10x. But that's your sell side, so let's see what happens. Okay, I think that's where you got your profit. Yeah, so 5.09 R is taken, but as you can see, it still didn't go lower than that, so already you got your profit. Okay, around that area you saw, like that's your profit. Now let's wait and see what happens in the market. It didn't take the sell side yet. Okay, so maybe my take profit is a tick or two higher than that. However, I hope by this time you already made enough money to close the position. If not, let's see what happens here. Remember that POI line. Okay, this one is very important. I'm gonna, should I extend this? I don't know, because that position is already done. If you didn't take your profit, this is where you got your sell side delivery. Now you saw price came here. Okay, let me just take up the positioning tool. As you saw, I didn't hit any stop loss or anything. Okay, point of interest, if this is not the profit, if you targeted lower than that, that's your profit done below that sell side liquidity, however you want to take it. In this case 5.21. now let me give you another thing. At this specific moment, market came this close to your dealing range sell side. Okay, it didn't take your sell side, instead it went higher. Now the first thing is, let's say you are still in a trade or you didn't take the entry. You saw everything, you calculated your dealing range, you saw the pullback on higher time frame, everything you have calculated during these moments. Price didn't take the sell side, it created too many relative equal lows over here. It created or generated more liquidity. Now look what's happening around this area. Market consistently taking the buy side, creating sell side. Inside of your dealing range, you are getting another dealing range, and that's confirming that eventually market will come lower after retracing a certain level or certain area of the price. So that's the fair value we took entry from. As you can see, if you didn't take entry here, you have options here. If you didn't take entry there, let's see what happened here, because remember, price still left that sell side untouched. At the same time, it created more of your sell side and dealing range. As you can see, price took the buy side liquidity, also some recent swing highs from the left, but mostly I want to focus here. And then you have got your market structure shift. So in this case, liquidity, market structure. And if you are lucky enough to take the profit here, this is another opportunity that you are getting to take another entry. Why I'm saying this is because, is it clear that it's a liquidity and market structure shift? If you count anything in between, let's say this is your market structure shift, is it clear? You have one fair value, you have two fair, oh sorry, this is number 3 fair value. So you have number 2, number 1. You see there is this little fair value that should act as your breakaway gap. Look, it just tapped there, left the portion unfilled, came lower. But what did I suggest you guys to take your entry from? The first fair value, if this is your market structure. Okay, so market structure, liquidity, market structure. Now that's your third fair value that you don't want to take entry from. Why? Because if you look into the high to low and your OTG, look, where is it aligning with? That fair value gaps low and that's your 6 on level, that's aligning the higher part of your fair value gap. So premium discount OTC, however you want to do it, that's above your premium, so you can use this fair value as your entry, or if you are using OTC you can use the 6-2 or 7 on, whatever aligning over there, okay, with the point of interest. Also you have a small little balance price range over there as well. So if you didn't take the first entry, or even if you made the profit, you can risk a little portion of your profit. I don't really suggest that, but anyway, if you are willing to trade, that's where you can enter one more time. Let's say you didn't enter when this retracement happened or this retracement happened. Remember what I talked about inducement. This is a swing high market, short-term swing high market created. This is a short-term swing high that market created and took all these liquidities. Again you got your market structure shift at this swing low. Okay, oh, I'm using the wrong tool. Now look, if you have enough fair value gaps over there or not. So one fair value, two fair value. You want to enter here, where should be your stop loss? At this, right? The second fair value gap or the first fair value gap candles high. So let me just put the fair value and breakaway gap that happened. Why I'm showing this is because it's important. If you miss one opportunity and if you can calculate it properly, see it's created the recent like relative equals, this is where you can still utilize the same thing. Now if you see market, you hit your stop loss and market took this liquidity, what you wait for is a retracement, then a W to form, or this pattern, like let's say market went here, you hit a stop loss after taking this entry, it created something like this. Okay, after taking that it came lower, took some liquidity from left, it gave you a new market structure shift like this. Okay, so now you have a liquidity grab, market structure shift that confirms that it's going for that buy side. So what you could do is you could simply wait for the retracement to your zone, or on this leg wherever the point of interest is, you can enter from here and targeting what? Nothing but this buy side liquidity, nothing in between, cause you know what gonna happen from my first video. When price doesn't take the sell side and goes above the number 4, in this case okay, so accumulation or engineered liquidity, manipulation, then distribution, then rebalance. This is step number 4. When the number 4 liquidity is taken, that is where you change or shift your bias towards the buy side. So if there is a fair value gap around this area, you enter from here, you can put your stop loss according to the calculation what I said, the fair value gap candles low or high. You will still get a huge risk to reward around this area, just from that to that. Let's say it didn't come until that far, it came until this far, your stop loss at the swing low, which you probably won't need. Okay, you will still get a huge risk to reward like this. So you will medicate your loss or whatever you have done during all these things, or your bias was correct, all this move happened, you still are not profitable, you lost your money by taking this sort of entry. That's where you target. So market will eventually go and deliver you that, and that's how you turn your losing day into a winning day. Okay, but if you lose, let's say you entered into a wrong position, you didn't wait for your market structure shift and retest, things like that, if you are losing multiple times, I suggest if you lose 2 trades in a row, don't trade that day, because if you trade the third time, that will be a revenge trade and there is a high probability that you will calculate everything wrong and you will lose your money one more time. So yeah, what I was saying here is you have multiple areas to enter. If you didn't enter here, that's inducement is taken, another liquidity grab, market structure shift, 1 fair value, 2 fair value. If you enter from fair value number 1, your stop loss has to be the breakaway gap candles high or the third candle, in this case the swing high, wherever you want to put it to be safe. Now you are safe over there. If you think that is happening, that sell side liquidity will be your target. Now you are getting a 3.8er instead of that 5er or something, you are getting 3.8er. That's more like, see here, with $500 risk you are getting almost $1,900 in a single trade. Do you need any more? And what I said about closing partial at 1 to 2, if you close your partial position, you will secure your profit, move your stop loss to break even or even 1 or 2 tick lower once you hit that 1 to 2 or once you close that partial. So after this candle happened, you move your stop loss to break even or maybe 1 or 2 tick lower, so that the commissions and fees will be covered as well if you got hit again. But what happens is that partial can still mitigate your another loss or previous loss. That partial profit can still give you back the money you lost previously, or if you have lost at all. If not, even if the market reverses after, let's say after this market reverses and hits your break even stop loss, you are still in profit by how much? At least by $500. So I hope you are getting my point. Taking partial is very important, and I have so many video recorded throughout the month of December. I have traded very few days, maybe 5 or 6 days in total, and all the trades that I have taken, I have the video recorded. Hopefully soon I will try to like make some sort of combined reel type of video or something, trade execution back to back, something like that, and I will give you guys the video as well. So yeah, I hope you got my point. Until next time, take a very good care and bye bye.